When you had a job, taxes were simple. Your employer took money out of every paycheck and sent it to the IRS on your behalf. You never had to think about it. The moment you retire, that entire system stops and nobody explains what replaces it. You are suddenly thrust into a complete financial wilderness where every single decision you make has massive consequences. If you make one mistake, you could lose thousands of dollars to unnecessary taxes and face a dramatic surprise penalty. The fear of making a mistake is paralyzing for most people, but today we are putting an end to that anxiety. I am going to walk you through the 10 exact things the IRS expects you to do the moment you retire, because most people miss all of them. I am going to give you the optimal strategies to keep your money safe. This is not just theory, this is real-world application. We will run the math together so you can see exactly how to protect your wealth. The first thing the IRS expects you to do is set up estimated tax payments. When you were on autopilot with your employer, they withheld taxes automatically. Now that you are drawing from retirement accounts, pensions, or investment portfolios, the IRS still demands to be paid as you earn. If you just wait until April to file your return, you are going to get hit with an underpayment penalty. Let us look at a real-world tax math example. Imagine you withdraw $60,000 from your traditional IRA in your first year of retirement. If you do not withhold taxes at the time of the distribution and you wait until tax season, you might owe $12,000 in taxes plus an additional penalty of around $800 just for paying late. To avoid this massive mistake, you must calculate your projected tax liability and send quarterly estimated tax payments to the IRS using Form 1040-ES. You have to be proactive. You must claim control over your cash flow. If you do not want to mail in quarterly checks, you can instruct your brokerage to withhold taxes directly from your distributions, but you have to specify the exact percentage. This dramatically reduces your risk of a surprise penalty. The IRS assumes you know this, but nobody sends you a letter explaining it. You have to take the initiative to set up these estimated tax payments immediately upon retiring, so your financial plan stays on track and you do not lose your hard-earned money to ridiculous fees. The second thing you must do involves your Social Security benefits and a very specific piece of paperwork called Form W-4V. A lot of retirees operate under the false assumption that Social Security is entirely tax-free. That is a dangerous myth. Depending on your other income, up to 85% of your Social Security benefits could be subject to federal income taxes. If you just start collecting your monthly checks without planning for this, you are setting yourself up for a terrible tax season. To fix this, you need to submit Form W-4V to the Social Security Administration. This form is a voluntary withholding request. It allows you to ask the government to automatically hold back 7, 10, 12, or 22% of your monthly benefit for taxes. Let us run the math. If your monthly benefit is $2,500 and you select a 10% withholding rate, $250 will go straight to the IRS every month. That is $3,000 a year paid automatically. By doing this, you put a portion of your tax life back on autopilot. You eliminate the fear of coming up short in April. Most people do not even know Form W-4V exists until their accountant asks them why they owe so much money. You need to download this form, figure out your optimal withholding percentage based on your total income, and mail it to your local Social Security office. Do not let the IRS hit you with a massive tax bill because you failed to complete this one simple, beautiful piece of paperwork. The third critical task is calculating and managing your provisional income. This is the exact formula the IRS uses to determine how much of your Social Security is taxable. It is a massive trap for the unwary. Provisional income is calculated by taking your adjusted gross income, adding any tax-exempt interest you might have from municipal bonds, and then adding 50% of your Social Security benefits. If you are married filing jointly and your provisional income is between $32,000 and $44,000, up to 50% of your benefits are taxable. If it is over $44,000, up to 85% becomes taxable. Here is a real-world tax math scenario. Let us say you and your spouse have $40,000 in IRA withdrawals, $10,000 in tax-free municipal bond interest, and $30,000 in Social Security. Your provisional income is $40,000 plus $10,000 plus $15,000, which equals $65,000. Because $65,000 is way over the $44,000 threshold, 85% of your Social Security is dragged into your taxable income. You have to manage this dramatically. You can lower your provisional income by strategically drawing from Roth accounts instead of traditional IRAs, because Roth distributions do not count toward provisional income. If you can keep that provisional income below the thresholds, you can literally save thousands of dollars a year in taxes. The IRS expects you to just blindly withdraw money and pay the maximum tax, but armed with this knowledge, you can structure your withdrawals to maintain optimal tax efficiency. The fourth thing the IRS expects you to miss is the senior bonus deduction, officially known as the higher standard deduction for seniors. The moment you or your spouse turn 65, you are legally entitled to a larger standard deduction, but you actually have to claim it properly on your tax return. For a married couple filing jointly where both spouses are over 65, this additional deduction can reduce your taxable income by over $3,000. Let us look at the math. If you are in the 22% tax bracket, an extra $3,000 deduction saves you $660 in cold hard cash every single year. But here is the catch. Tax software does not always automatically check the box indicating you are over 65, especially if you just turned 65 during the tax year. If you are filling out your own forms, you have to look closely at the standard deduction chart and make sure you are taking the absolute maximum amount legally allowed. Many people simply copy what they did the year before, completely missing this massive benefit. You must update your tax strategy to reflect your new age status. The IRS is not going to call you and remind you to take a larger deduction. They will happily accept your overpayment. You have to be militant about claiming every single dollar. This beautiful little senior bonus is your reward for reaching retirement age, so do not let a simple administrative mistake cost you money that rightfully belongs in your pocket. The fifth requirement is mastering the timing of your required minimum distributions, or RMDs, specifically under the new rules of the Secure 2.0 Act. The IRS forces you to start pulling money out of your pre-tax retirement accounts at a certain age, and if you miss the deadline, the penalty is absolutely brutal. Previously, the age was 72, but the Secure 2.0 Act pushed the starting age to 73 and eventually to 75. The IRS expects you to know exactly when your personal deadline hits. The penalty for missing an RMD used to be a staggering 50% of the amount you were supposed to withdraw, and even though it has been reduced to 25% or 10% if corrected quickly, it is still a massive loss. Let us do the math. If your RMD for the year is $20,000 and you simply forget to withdraw it, you could face a penalty of $5,000. That is $5,000 gone forever, just because you missed a date on the calendar. To avoid this, you must calculate your RMD using the IRS Uniform Lifetime Table. You take your account balance on December 31st of the previous year and divide it by your life expectancy factor. You must withdraw that exact amount or more by December 31st of the current year. Your very first RMD has a special rule where you can delay it until April 1st of the year after you turn the required age, but if you do that, you will have to take 2 RMDs in 1 year, which could dramatically push you into a higher tax bracket. You have to map this out carefully to ensure optimal tax flow. The sixth strategy you need to deploy is the Qualified Charitable Distribution, or QCD. This is one of the most powerful tax loopholes in the entire tax code, but most retirees completely ignore it. When you reach age 70 and a half, you are allowed to transfer up to $105,000 per year directly from your traditional IRA to a qualified charity. Why is this so important? Because a QCD counts toward your required minimum distribution, but it does not count as taxable income. If you just withdraw the money, put it in your checking account, and then write a check to a charity, that withdrawal increases your adjusted gross income. This can trigger the taxation of your Social Security and increase your Medicare premiums. Let us look at a real-world example. You have a $10,000 RMD, and you want to give $10,000 to your church. If you take the money out first, your income goes up by $10,000. If you do a QCD instead, your income goes up by 0. You satisfy the IRS, you help the charity, and you keep your taxes dramatically lower. You must instruct your IRA custodian to send the check directly to the charity. Do not touch the money yourself. The IRS expects you to miss this nuance and claim the charitable deduction on Schedule 1A, which might not even help you if you take the standard deduction. By using a QCD, you get a beautiful tax benefit regardless of whether you itemize or take the standard deduction, completely outsmarting the system. If you are finding this information valuable and you want to keep protecting your money from the IRS, hit the subscribe button right now. We post videos every single week to help you navigate retirement, and subscribing is the best way to ensure you never miss a massive tax-saving strategy. The seventh thing the IRS expects you to evaluate is the strategic use of Roth conversions during the early years of your retirement. When you retire, there is often a gap between when your paychecks stop and when your Social Security and RMDs begin. This creates a window where your income is dramatically lower than it has ever been, putting you in a very low tax bracket. The IRS knows that if you wait until your RMDs start, you will be forced to withdraw money at much higher tax rates. To beat them at their own game, you must convert portions of your traditional IRA into a Roth IRA during these low-income years. You will pay taxes on the converted amount now, but you will pay them at a heavily discounted rate. Let us run the math on this. Imagine you are in the 12% tax bracket right now, but when your RMDs and Social Security kick in, you will be pushed into the 22% bracket. If you convert $50,000 now, you pay $6,000 in taxes. If you wait and withdraw that same $50,000 later in the 22% bracket, you will pay $11,000. You just saved $5,000 simply by choosing when to pay the tax. Once the money is in the Roth IRA, it grows completely tax-free and is never subject to RMDs. You have to run the projections and convert the optimal amount each year to fill up your low tax brackets without spilling over into the higher ones, taking complete control of your lifetime tax liability. The eighth critical factor you must manage is IRMAA, which stands for the Income-Related Monthly Adjustment Amount. This is a hidden tax on your Medicare Part B and Part D premiums, and it catches almost everyone by surprise. The IRS and the Social Security Administration look at your tax return from 2 years prior to determine your Medicare premiums today. If your modified adjusted gross income crosses certain threshold brackets, your Medicare premiums can double or even triple. The IRS expects you to unknowingly trigger these surcharges. For example, if you are married filing jointly and your income is under $206,000, you pay the standard base premium. But if you sell a house, do a massive Roth conversion, or take a large IRA distribution that pushes your income just $1 over that threshold, you will suddenly be hit with an IRMAA surcharge that costs you hundreds of extra dollars every month. Let us do the math. A couple might normally pay around $350 a month for Medicare Part B. If they trigger IRMA, that combined premium could jump to $500 or more, costing them nearly $2,000 extra a year. To prevent this, you must carefully monitor your income and stay just below the IRMA brackets. If you had a life-changing event like retiring and your income dropped dramatically, you can actually file Form SSA 44 to request a reduction in your IRMAA surcharge. You must fight back against these hidden penalties and keep your healthcare costs optimal. The ninth thing you have to do is officially update your address with the IRS using Form 8822. When people retire, they often downsize, move to a cheaper state, or buy a house near their grandchildren. If you move and do not directly notify the IRS, you are playing a very dangerous game. The IRS sends all official correspondence, including notices of audits, tax bills, and requests for missing information, to your last known address. If they send a notice of a penalty to your old house and you never receive it, the penalty will continue to grow, accumulating massive interest. The IRS does not care that you did not get the letter, they only care that they mailed it. You cannot rely on the post office forwarding service because it eventually expires, and government mail is sometimes not forwarded at all. You have to fill out Form 8822 and mail it in to completely update your records. Imagine the fear of discovering years later that a minor tax mistake has snowballed into a massive lien on your new home just because of a wrong zip code. By taking 5 minutes to update your address, you guarantee that you will receive your tax refunds on time, and you will never be surprised by a hidden penalty. The IRS expects you to drop the ball on this simple administrative task, but you have to be proactive to protect your peace of mind. The 10th and final thing you must completely reevaluate is the choice between standard and itemized deductions, specifically regarding the SALT deduction cap. When you were working, you might have always itemized your deductions because you had high state income taxes, high property taxes, and massive mortgage interest. But in retirement, your financial picture dramatically changes. Your mortgage might be paid off, your income is lower, and the Tax Cuts and Jobs Act placed a strict $10,000 cap on the state and local tax deduction, known as the SALT deduction cap. The IRS expects you to waste hours trying to itemize when it no longer benefits you, or worse, to blindly take the standard deduction when itemizing could actually save you money due to high out-of-pocket medical expenses. Let us run the math. If you are a married couple over 65, your standard deduction is over $30,000. To make itemizing worth it, your total deductible expenses must exceed that amount. If your property taxes are capped at $10,000 and you have no mortgage, you would need over $20,000 in medical expenses or charitable contributions to even begin to see a benefit. You have to sit down with your receipts and run the numbers both ways. Do not let the habit of itemizing force you into a suboptimal tax outcome. You must analyze your unique situation under the current tax laws to ensure you are claiming the absolute largest deduction possible, shielding your retirement income from the IRS. Let us do a rapid-fire recap of everything you need to do to secure your retirement. You must set up estimated tax payments to avoid underpayment fees. You must file Form W-4V to withhold taxes from Social Security. You must calculate your provisional income to minimize the tax on your benefits. You must actively claim the senior bonus deduction. You must master your RMD timing under the Secure 2.0 Act to avoid massive penalties. You must utilize QCDs to lower your taxable income while giving to charity. You must execute Roth conversions during your low-income gap years. You must monitor your income to avoid the IRMAA Medicare trap. You must file Form 8822 to update your address with the IRS. And finally, you must run the math on the standard versus itemized deductions considering the SALT deduction cap. The stakes are incredibly high. The transition into retirement is fraught with financial danger, but armed with this 10-point checklist, you now have the power to protect your wealth and achieve complete financial peace of mind. Which of these 10 did you not know about? Let me know down in the comments below.